Hello and welcome to Portfolio Matters Weekly Market Checklist, week 175. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Thank you, Richard. Well, first of all, the news. And you've seen from the frontispiece this week, that was a graphic produced by the new joint head of the Department of Government Efficiency in the US, Vivek Ramaswamy. And Donald Trump seems to be attempting to deliver on all his campaign promises by appointing very unlikely candidates for all the departments of government. So Elon Musk and Vivek Ramaswamy have been appointed heads of the Department of Government Efficiency with the aim of cutting 2 trillion off the US budget. And he's appointed a former member of the board of Worldwide Wrestling as World Wrestling Entertainment as the head of the Department of Education, and he has previously said he would like to abolish the head of the Department of Education. Let's see what happens. It's going to be a very entertaining year in the US. Whether that's good or bad, we just don't know. Meanwhile, Ukraine has fired both UK and US cruise missiles deep into Russian territory in an escalation of the war, and Russia has responded with hypersonic missiles and nuclear saber rattling. Oil rose. US inflation came in on target, but no longer seems to be falling steadily. UK October inflation came in hot, bouncing back well above the 2% target at 2.3%. The US economy still seems to be ticking along nicely. US retail sales were strong. UK retail sales were weak, and the UK economy looks to be weakening. We will take you through the data. Nvidia beat earnings, but the shares fell. Now, quickly before we move on, Donald Trump has been talking about cutting the size of the US budget, and he's appointed Donald Trump to take a chainsaw to it. Now, there is a history of trying to cut the size of the US fiscal budget, and the previous big attempt was under Ronald Reagan, the Grace Commission, 1982. Ronald Reagan was appointed on the promise to drain the swamp, he said, and to cut waste and efficiency in the US. So the Grace Commission took 2 years to report, and the report was presented to Congress in January 1984. The Commission issued 36 reports and 11 Management Office reports containing 2,478 recommendations, with the aim of saving 424 billion if those its recommendations were implemented. And that would lead to cumulative savings of 10.5 trillion by 2000. And amongst the examples of egregious wasteful spending they found was the Department of Defense spending $436 for a hammer, $600 for a toilet seat, and $7,000 for a coffee maker in an aircraft. As an aside, my sister-in-law works for the NHS, and if she wants a new chair, the catalogue gives her the options. The cheapest one is 650 quid. Reports recommendations that intruded into policy were ignored by Congress, and the recommendations were largely not implemented. However, some of it was implemented, and Citizens Against Government Waste have documented that they believe cumulative savings to 2020 were 1.9 trillion from the implemented recommendations of the Grace Commission. So, although all of it wasn't implemented, some of it was. So, history suggests that the DOGE will have some effect, but nowhere near as much effect as they would like. And this is a tweet from the Department of Government Efficiency, Elon Musk. It sounds like he's really going to try and cut the size of the government. Let's see what happens. And in October, the US fiscal deficit was the second largest on record. So he's got a big job on his hands. But so far, the markets don't believe him. They think that Donald Trump will raise the deficit by cutting taxes, and that will lead to higher inflation. Elsewhere, in France, we've been talking about the French budget for quite a long time now. It still has not been passed. Reminder, France is attempting to cut the deficit and implement austerity, well, limited austerity. The right-wing Rally National, with 130 seats, is now threatening to bring a no confidence vote in the government. And reminder, France last balanced the books in 1974. Meanwhile, Bitcoin continues its stratospheric rise and is approaching 100,000. And the crypto bubble is spreading everywhere. This is a cryptocurrency called Peanut. And talking about Donald Trump, well, these are his picks for Department of Education. She is formerly on the board of World Wrestling Federation. And that's Dr. Oz from TV. He's been put in charge of Medicare and Medicaid. Vaccine skeptic Robert F. Kennedy has been appointed head of the health department. And I hear that vast numbers of employees at the Department of Health are now planning to resign in protest. Let's see whether they do.
So actually, that would be part of Elon Musk's strategy, presumably.
Well, yeah, exactly. So now on the Discord, we've been having a debate about this, and you can judge for yourselves whether I'm succumbing to a conspiracy theory. But this is Donald Trump's nomination for the Defense Secretary, Pete Hegseth, a veteran and a Fox News host with no experience of government, who he's appointed to run the Department of Security with a budget approaching $1 trillion. Now, his big tattoo is the Jerusalem cross, liked by right-wing extremists. And now this tattoo on the left says, "We the people." But when my wife looked at it, and she speaks some German, she said, "That says Weisse." I leave it up to you whether that is conspiracy theory too far or not. And on to this week's economic data. Quick summary and reminder. Donald Trump is going to upend all this. So we're going to rush through all the economic data again, because when he comes in, if he puts tariffs in, everything could change. Currently, the UK is not doing well. The latest data from the UK suggests that post-budget, the UK private sector is weakening. Now, the question is then, how much will increased public sector spending offset that weakness in the coming year? The EU economy appears to be weakening again. The US is strong. China is weak, but possibly improving. Richard, the UK.
Okay, UK CPI worse than projected, as Keith said, 0.6% for the
Yeah,
month.
not good.
Not the right trend at all.
Yeah.
Year on year hasn't really impacted year-on-year numbers yet. It's still at 2.2, 2.3%. A little bit worse, but we'll have to see where this goes in the next few months.
Well, sorry, Richard, it has impacted the numbers. I mean, the thing is, it's mainly driven by energy.
Okay.
Do you want to do that again?
No, I'm happy to see. There's
Right,
a
okay.
big dispute.
Right, okay.
Because I don't think it has really.
Right.
We'll see. UK core CPI, month on month worse than expected. 0.4%. Core CPI year on year still falling, but still too high. And UK RPI month on month, 0.5%, year on year, 3.4%. So both of those too high.
Yeah, and RPI, if you look at that, it's basically stopped falling. It's been flat for 6 months.
Yeah. Energy prices being the main cause of the inflation, with gas rising significantly, 10% in October. Services inflation is still slowly dropping, but it's at near 5%, so it is too high.
Yeah.
And the uplift in inflation was all due to the cost of energy.
Yeah, I noticed recreation and culture actually continues to fall. That's good news.
Yeah. So UK input PPI monthly was 0.1% in October, which is very low. And year on year, it's down 2.3%. And output PPI was unchanged in October, and year on year was down 0.8%. So those numbers heading in the right direction.
Yeah. No, I don't know. So that's factory gate inflation, and I don't know whether that includes any services, but it's clearly good for inflation. But all the inflation in the UK is coming from services.
Yeah. UK earnings growth was at 4.3%, significantly worse than expectations, and also significantly above the inflation numbers.
Yeah.
And excluding bonuses was 4.8%, which means bonuses have dropped. And again, too high for a stable rate of inflation, 2%.
And the other thing is that the 5.5% increase in public sector pay takes effect in October and is backdated to September.
Yeah.
So the next figures are going to be bad.
Yeah. The UK unemployment rate, 4.3% in September. So there's a general uptrend there, but it's quite a sort of noisy one. And the 3-month employment change, up 220,000 in September, which contradicts the unemployment numbers, really, I guess.
Yeah, it does.
The UK claimant count is sort of falling. It's hard to interpret what that graph is really telling us.
More people are claiming unemployment benefit. So there's a net positive to people claiming unemployment benefits, suggesting unemployment is rising. But that number is not compatible with a rise of 0.3% in the unemployment rate in 1 month.
As you know, the UK employment figures all over the place at the moment. HMRC payrolls down 5,000 in September, as opposed to expected to be up.
The
So the
graph
suggestion
is
that UK employment is sort of rolling over a bit, isn't it?
Yes, that's right. So there's big contradiction between the HMRC numbers and the labour force survey. The labour force survey is showing strong employment growth. The HMRC data is showing that payrolls are weak and weakening.
UK GDP growth rate quarter on quarter, 0.1%, so tiny. And within the variability of the rate of inflation, I would suggest UK GDP growth year on year, 1% in quarter 3. So very low growth rates. And since the pandemic, our growth rate has been anemic. It's almost leveled off, hasn't it, Keith?
Yeah.
And in September, services sector stalled, while production growth fell, went negative. And consumers appear to have reduced travelling and spending more locally in pubs and social activities.
Yeah. I thought that was quite interesting, actually.
Yeah, so signs of cutting back, taking out the peripheral expenditure from a night out and so forth.
Yeah, what I found quite odd, though, was this increasing in expenditure on repair of motor vehicles and motorcycles, because I'm expecting that the shift to EVs is going to massively reduce that medium term. They don't need servicing.
Yeah. UK GDP growth rate month on month was negative 0.1%. So UK looking like it's got a sticky inflation problem and negative or very low growth. UK retail sales month on month down 0.7%. Again, not a very healthy figure, worse than consensus. UK retail sales year on year are up 2.4%, which is lower than consensus. UK construction new orders year on year was down 9.4%, much lower than consensus. So
Yeah,
significant slowdown there.
I was very surprised by that because we had a huge bounce back in Q2, and
Yeah.
then the government's now going to start pushing a lot of public sector construction spending.
UK labour productivity down 0.8%. And that is really bad, isn't it? Because if we're trying to improve our GDP,
Yeah,
increase our economic efficiency, for productivity to drop
yeah.
like that is really bad.
No, it is a super bad number, and because it suggests that people are getting less efficient at producing things. But um, I think that suggests, previously we were talking about the UK employment change over the last 3 months, and it's the labour force survey is showing that a net increase in employment of 200 and whatever thousand.
Yeah.
Well, if they're wrong and the claimant count and how much HMRC payrolls are right, i.e., employment has barely changed or fallen, then labour productivity is a function of the number of people in work. And that would mean
Yeah.
productivity is better.
Yeah.
However, Richard, this week there was a report in the FT talking about the Resolution Foundation. And the Resolution Foundation have been through HMRC payroll data, and they think that the labour force survey is underestimating UK employment by a massive 930,000 people. So that they're saying that the ONS are underestimating the total number of
Mm.
people in employment in the UK by almost a million. Now,
Mm.
there are 28.9 million salaried employees in the UK.
Yeah. So that's,
If the Resolution Foundation are correct, that means labour productivity is terrible. It
yeah.
means you fall by another 3%.
Well,
So,
we've become such a bureaucratized country. Apart from anything else, we have an awful lot of people who do totally non-productive things.
yeah, I totally agree. We're adding people in, what's it called? EDI? It's like
Yeah.
equality, diversity, and what's the other one?
Yeah.
Inefficiency.
Inclusion, Keith.
Oh, right, sorry.
I mean, yeah. UK industrial output month on month down 0.5% in September. It's sort of
Yeah,
not great.
not great.
UK industrial output year on year down 1.8% in September. That, really not great. UK S&P Global Manufacturing PMI 48.6 falling.
Yeah.
Post-election basically falling.
Well, the thing is, it does appear that appears to be a trend now.
Yeah,
Does appear to be heading back down again.
it does. UK S&P Global Services PMI also falling.
Yeah. And that again looks to be a trend.
Yeah,
And when the economy is expanding normally, services generally are between 53 and 55. So
yeah.
50 is a poor number.
So the composite PMI is, of course, also falling and
Yeah.
below 50 now. The UK balance of trade is and has been negative for the last nearly 2 years, apart from a minor blip in the middle of 2023, late 2023. Public sector borrowing requirement, profoundly negative, staying that way.
Yes. And worse than expected.
Yeah. The house price balance is actually continuing its uptrend.
I know. I'm mystified. Absolutely mystified by that. So,
Yeah.
given the rise in interest rates,
Yeah.
yeah,
And the UK consumer confidence, I mean, it's such a negative chart, so I don't know what to do about this one, isn't it? But it's better than it was a year ago, but it's not very
yeah,
good. And the economic surprise index fell last week significantly.
yeah, not good. UK underperforming.
The Indeed job postings continuing that steady downtrend.
Yeah, and actually now getting quite serious, actually.
Yeah.
So there are 15% fewer job postings than there were pre-pandemic.
And UK wage growth, 6.7% as measured by advertised wages. So that is really, really significantly high and
No,
higher than the employed wage growth.
well, yeah, the thing is, Richard, there's how much there must be something to do with the employment mix here, because we've had last year mandated rise in the minimum wage. Was it 12%? And we're just
Mm.
about to have another, was it 5.7% or something? So, you know, this is not going to come down as long as we're having mandated stagflation in the UK as the government raises wages.
So markets are expecting the Bank of England to cut interest rates to only 4% by the end of, so only a small cut in interest rates
Yeah.
to 4% by the end of next year.
Yep.
And history shows that the deficit consistently overshoots the OBR's forecast. So what we're really saying is the OBR is going to be overshot to the downside again, despite the stonking tax increases.
Yeah. And I don't think this is necessarily the OBR's fault. It's the government. The moment it starts looking like we're going to actually reduce the deficit, they start spending again. And I think the Labour government is now killing the economy, which means that unemployment's going to rise, benefits going to rise, that their tax revenues will undershoot, the deficit will rise again. So they've promised to balance the budget. Will they raise taxes again? They are putting us into a negative spiral. Let's see what they do.
So total tax rates on employment, which employer plus employee in the UK. So basically, well, you can see the numbers for yourself, and um,
Yeah.
we are far too highly taxed. And actually, the taxation rates now a negative incentive. I think that Rachel Reeves has totally, totally misread the economic consequences of her tax increases.
Well,
I
I think
simply
that's
didn't
true.
understand it.
I mean, I don't know whether about you, Richard, but I just feel that there's the zeitgeist, the mood has shifted down
Yeah,
after the budget.
yeah.
Um, Now we've got a section coming up on the effect of all this on young people. So students with graduate debt now have to start repaying that debt above 25 grand, and they first face a further 9% incremental tax. So that is a big burden.
UK industrial electricity prices are the highest in the developed world. Well, that's good for the economy, isn't it? Did you see Ed Miliband? I mean, Ed Miliband is like complete completely out of touch with reality. And his solution to the UK's energy problems is more wind farms, and he's not interested in nuclear. I mean, he's such a dangerous man.
Yeah. So I wanted to have a deeper look at the UK's carbon capture scheme, but we've got far too much this week already. I will do it next week.
So, in summary, inflation is higher than expected, growth is lower than expected, retail sales fell, and PMI suggest we're slipping back into recession. It's not good news. Stagflation, question mark, are probably possibly already in here. I think
Yeah.
informally, as Keith and I have just said, people are feeling pretty bad about the economy, the tax increases, the handling of things by the Labour government have been inept, in my view. And Deanne Julius has warned of the dangers of stagflation, which
Mm.
I think it's here actually.
Yeah.
And I think the government does not understand actually how the private sector works and how it drives economic wealth. And things aren't great in this country, and they inherited a mess, but they are making the mess worse, not better. That's
Yeah.
my summary.
The cheery message of the week from Richard Wheater. You heard it here first. And on that front, the weekly quiz. Okay. Thank you to viewer Martin Beadle for this. Okay, tube drivers have won a new pay deal. How much they earn and how many hours a week do they work? Bear in mind, they don't have to steal or anything. They don't have to deal with, drunken passengers one to one like an Uber driver. Go on.
We'll have a guess.
Yeah,
£65,000 and 30 hours a week?
Actually, Richard, well,
Which one you
so
want?
it's £70,000 a year. And you're not far off actually, because there's been no change to their contractual 35 hours a week, but their half-hour meal breaks are now included in time worked. So that means they actually only work 32 and a half hours a week, and that means a 4-day week. So if you account for the reduction in their working hours, then their actual pay rise is 12.5%.
Roll on driverless trains.
Yeah, well, yeah, absolutely.
That's
The
obviously
job's
where it's
so
going.
difficult that a robot could do it. But the yeah, chance of it. The thing is, train drivers regularly hold the country to ransom. That's why they've got such high wages, and I've got Labour government who's just going to cave into them at every opportunity. And on that cheery note, on to the EU.
Where we have some good news, I presume, Keith.
No, wait for the US for that, Richard. Okay, so in the EU, inflation came in on target at 0.3% in October. Year on year, it's at 2%, so on target, and that's after the energy price rises. So actually, inflation looks okay in the Eurozone, but core remains far too high. Just like the UK, there's a problem with persistent high wage rises and service sector inflation. And frankly, core in the EU does not look to be coming down fast enough. GDP growth actually bounced back in Q3, although it was revised down to 0.4%. The growth rate year on year was an anemic 0.9%. Employment growth, well, still continues in the EU, actually up 0.2% quarter on quarter, 1% year on year. And unemployment in the EU is at a record low. The labour cost index, though, continuing to rise too fast for the ECB to be comfortable. So 4.6% quarter on quarter in Q3. Industrial production had a bad month in September, down 2%. Year on year, down 2.8%. Industrial production in Europe is falling. And we've talked previously about Germany. High energy prices in Europe are a big impediment. Consumer confidence ticked down in November. And the PMIs, like in the UK, were weak. Manufacturing ticked down to 45.2. That's a very poor number. Services fell very sharply in November to 49.2. That's back into contraction territory. So the composite fell very sharply from 50 in October to 48.1 in November. The Eurozone looks to be heading back into recession if you believe the PMIs. And just like the UK, that seems to be a trend. The ZEW Economic Sentiment Index, which is a survey of economists, their outlook fell sharply in November down to 12.5. The current account balance, though, is good, up to 52 billion in September, well above expectations. So the Eurozone continues to try to export its way out of problems. The economic surprise index, having strengthened over the last couple of months, took a sudden dive over the last couple of weeks, negative once again. German Indeed job postings continuing to trend down. Wage growth actually ticking down. French job postings also ticking down. Wage growth well beneath the ECB's target, which is good news. This is German industrial productions and chemicals and pharmaceuticals. And you'll see that is now well below, well, it's at a low. So it's fallen over the last 15 years. But it has bounced back. Orders have bounced back a bit in September. And I'm expecting a bit of a bounce over the coming months as US importers try to get their orders in before Trump raises tariffs. And I thought this was interesting. This is EU air traffic. And This suggests that the EU economy is slowing. The black line here is the share of high yield bonds, i.e., loans to small companies that are maturing in the next 1 to 3 years. And you see that the EU is heavily exposed to interest rates. As higher interest rates stay higher for longer, so it's going to continue to hit EU smaller companies. And we talked earlier about the trade deficit. The blue bars are EU trade balance with the US is very strongly positive. The red is trade balance with China, enormously negative. So if the US imposes tariffs, the EU economy will suffer. So in summary, inflation bounced to 2%. Core inflation remains sticky, according to the ECB. And I haven't got a chart of this, but this is from news reports. The ECB estimates the wage growth in Q3 picked up to 5.4%. Now that puts the ECB in a big quandary because the data we've just shown you shows that the EU economy is slowing and seems to be heading back towards contraction and recession territory, but wage growth is far too high. So what will the ECB do? Stagflation in the Eurozone as well is where we are. And onto the US, Richard.
Thanks, Keith. So CPI, 0.2%, online with expectations. And CPI year on year, 2.6%, not far off from the target 2%. Core CPI month on month, 0.3%. Core CPI year on year, 3.3%. So core is a bit on the high side for them still.
Yeah, and really not coming down much.
And the market is very concerned about higher future inflation. But at the moment, inflation is relatively under control in the US.
Yeah, now we've got a few charts coming up on US CPI, and the bottom line is that most of the inflation you're getting in the US, and inflation does appear to be sticky if you look at core, but it's sticky because of rent, healthcare, and transportation, which is car insurance. And we've talked about this many times. Car insurance just continues to rise. It's a secular trend, and that is not going to be impacted by interest rates.
This is there are no hedonic adjustments to the price of a haircut because a haircut's a haircut, aren't they?
Yeah.
And the price of a haircut appears to be rising at 4.5%.
Yeah, steadily.
Yeah, steadily, which suggests that not all CPI numbers are the same.
Well, it suggests that actually service inflation is sticky.
Yeah.
How much are your haircuts, Richard?
£15. How about you?
I get my wife to do it, so they're free.
Goldman Sachs believe that the US labour market is cooling and that will allow inflation to come back down to the 2% target. But the inflation in shelter looks persistent and is above the 2% target.
Yeah.
So it's
exactly.
Yeah. So in order to bring down house pricing inflation, obviously house prices need to fall, and house prices are actually rising at the moment.
Yeah.
If you extract shelter, then inflation is looking benign, but if you include shelter, it's looking much less benign. And ultimately, you have to include shelter. It can be daunting, but it has to be included.
If Trump does start in deporting loads of immigrants, that will tend to bring rents down, but it will also bring wages up.
Yeah, distribution inflation components is heading back towards the pre-pandemic normal.
Yeah.
So inflation is being driven by secular price increases in a few sectors, as Keith mentioned earlier, vehicle insurance and housing particularly. This company, who's Parker Ross?
He's on Twitter. He runs an investment firm. I really like him. He does very deep work on unemployment, etc.
Okay.
in the US. But anyway, his model is like Goldman Sachs, forecasting CPI will continue to fall.
So the US PPI month on month up 0.2%, year on year 2.4%. But factory gate inflation is actually on a gentle upward trend there.
It is. It is.
Core PPI month up 0.3%, year on year up 3.1%. And again, we've got that upward trend.
Yeah.
US consumer inflation expectations have started to fall again, having stabilized for most of 2024.
Just as factory gate inflation is rising.
US retail sales month on month are up 0.4%. And year on year, they're up 2.8%, which is better than expectations.
Yeah. The US consumer remains perfectly fine.
Yeah. US net household debt continues to rise on a fairly steady upward trajectory since 2013, 14.
Yeah.
The Platts manufacturing PMI is 48.8%.
Still in recession territory, but not getting worse.
No. And services PMI is continuing to go up.
Yeah,
fairly
red hot.
strongly.
Yeah, red hot.
Yeah. And the composite PMI is also on an upward trajectory and makes the US economy look very strong.
Yep.
Business optimism is climbing. Economic optimism index is climbing sharply. That's the Trump effect, I guess.
Yep.
Michigan consumer sentiment is on a steady upward trend. It's been on for the last 2 years.
Yeah, what I found interesting about the consumer survey is the uplift in consumer sentiment is much smaller than I expected, given, Trump kind of coming in and pro-business.
Yeah. Yeah. US consumer current conditions.
Yeah, actually ticked down post-election.
Yeah. And consumer expectations on a strong uptrend. 1 year inflation expectations continuing the downtrend, continuing to fall. 5-year expectations continuing to, actually, they're on a little bit of an uptrend. US building permits at 1.4 million, just a little bit below expectation. US new housing starts, pretty much slightly below expectations, but quite strong. Existing home sales, are we starting to see a renaissance in existing home sales? Question.
Don't think so.
No.
Because how the interest rates have risen.
Yeah.
There's going to be a lag effect here of 6 weeks, I think.
The conference boarding leading index declining in October.
Yeah, it's been useless, frankly.
Yeah. And new orders continue to lead the decline in the leading index.
Yeah.
Get your head around that one if you can. US initial jobless claims down. And continuing jobless claims are up. And quite a lot up, really. And the trend is looking up. What's this chart showing us, Keith?
Okay, so it's just showing that, so what we've seen is that initial weekly jobless claims were below expectations, the continuing well above, but there are various holidays which cause havoc with the numbers over this period. So the numbers are very volatile, and that will continue for another few weeks. So just don't place too much reliance on them.
So this is showing seasonally adjusted claims, which are high and rising. And non-seasonally adjusted claims suggests that the rising continuing claims is less problematic.
Yeah, it actually seems to be rolling over a bit.
Yeah. And the Indeed jobs posting index is still declining, quite slowly at the moment. And wage growth is at 3.3%.
Yeah, actually good in the US. Posted job advert. If you don't mandate, the government doesn't mandate wage rises, then it seems to be coming down.
And LinkUp is reporting rapidly declining job postings in the US. on a
Yeah.
daily basis. But although on a monthly basis, it's a much slower decline.
Yeah. Well, we haven't got the November data for that yet. But I mean, the latest data, that's
Yeah,
odd.
yeah,
I'm, let's wait and see what happens. But that suggests it's different from the other. What's the other one we report? In,
the
it's
Indeed one.
different from Indeed.
Yeah. The weekly economic GDP estimate from the Dallas Fed, 2.7,
Sorry, two.
2, sorry, 2. And the Atlanta Fed GDP now is at 2.7. New York Fed GDP nowcast is at 1.9, and the St. Louis Fed is at 1.5. So they're all nicely positive.
Yeah.
Citigroup Economic Surprise Index is positive, and US Trueflation is at 2.8%.
Yeah. Having
Rising.
risen sharply.
Yeah. And it looks as if US immigration can probably fall back to its pre-pandemic pace under Trump, which would be a significant drop over the last
Yeah.
few years.
Now, listening to commentary, he is planning to deport lots of illegal immigrants. Now, initially, it's going to be illegal immigrants who have committed crimes, but then he's got target, and if you have, and he's going to be he hopes to be deporting millions of illegal immigrants a year.
Yeah.
Let's see what happens.
So in 2022, US citizens received 3.8 trillion in transfer income from the government, which is £11,500 per person,
Yeah,
which is a
yeah, that's the deficit. I mean, it's just totally unsustainable.
total US government workers, 23.4 million and rising sharply.
Yeah. We previously reported there were 28.9 salaried employees in the whole of the UK.
And this is the screenshot of the US public sector debt, which is now at 36 trillion and rising.
Yeah.
And not many US banks are still tightening lending standards. So our summary, inflation is rose to 2.6% and core is too high at 3.3%, being driven by insurance costs and healthcare costs and housing costs. Expectation is that inflation will slowly decline. Retail sales strong. The US economy is looking pretty healthy, really. Consumer confidence showed a little bit of an increase in November, and the US economy is doing just fine at the moment.
Yeah, but Donald Trump's going to throw some hand grenades in. We just
Yeah,
don't know what he's going to do. If
yeah,
he does raise tariffs, that will be bad for inflation. If he deports loads of illegal immigrants, that will be bad for inflation, good for wages.
yeah.
But also it should bring housing prices down. Um, if he takes a chainsaw to the government, then that's super bad well, it's very good for the fiscal balance, but it's very bad for the economy. So, we just have to wait and see what he does. And on to China. So house prices continue to decline at an accelerating rate, down 5.9% year on year in October. Not good. Industrial production, 5.3% year on year, weaker than expected. Retail sales, though, ticked up 4.8% year on year in October, well above expectations. So if the numbers are to be believed, then Chinese consumer is opening his wallet. Fixed asset investment going nowhere, 3.4%, steady decline actually. Foreign direct investment still declining at 30% a year, not great. The unemployment rate, 5%. Do you believe these numbers? Outstanding loan growth continuing to decline, 7.8%. This chart shows Chinese imports into the US, and they have already taken a big hit after Trump's tariffs, which Biden then rolled over. Now, if Donald Trump raises tariffs further to 60%, he's saying, then imports are going to fall further with negative implications for the Chinese economy. This is a chart of property transaction volume up to September, and you'll see it's not looking very good. We've been talking about how China is stuck in the bursting of a property bubble and house prices continue to decline. There's no reason for it to turn around. Thank you to Zendigan for sending us that. So China summary, house prices still falling. Industrial production growth is weakening. Retail sales, though, better than expected. Fundamentally, though, loan growth remains weak, so inflation is going nowhere. The Chinese economy looks like it's in a balance sheet recession following the bursting of an absolutely enormous property bubble. We expect China to grow old before it grows rich. Okay, one chart. So this is global debt to GDP, and it's 50% higher than it was 25 years ago, although down from its peak of the pandemic, thanks to inflation, I think.
Exactly, yes.
Okay, thanks to our Discord member Legion852, who sent me this paper on monetary policy and how long it takes to work. And so what the authors did was they looked at very detailed personal consumption prices for the period from 1982 to 2008, so pre the great financial crisis. And their conclusion was that monetary policy takes an awfully long time to work. Actually, so the effect of a 100 basis point shock in interest rates is shown, headline PCE response on the left. In the first few months, there is a mild fall in inflation, but then no effect whatsoever for 36 months. And only after 3 years is there a big response. And then 100 basis points rise in interest rates leads to around a 4% reduction in the price level after 3 years. If you look at core, similar. There's no effect for about 3 years. This is very odd. And they've broken it down by various sectors. You'll see durable goods. As you might expect, the response is quite fast. Non-durable goods, it really doesn't have much of an effect at all. Again, for like 3 years. Services, it has no effect whatsoever for the best part of 3.5 years. Now, the thing is, this paper just looks at the data. They don't attempt to interpret the results. And pause, take a look. This is the price response of various different sectors. Some sectors take a lot longer than others. So durable goods in the form of recreational vehicles, etc., that, as you might expect, has an immediate and lasting response to higher interest rates because they're very expensive items mainly bought on debt. It's not clear that there's much effect on most other sectors, frankly. Now, over that period, 1982 to 2008, there were 4 hiking cycles that they would have used the data for. And it seems to me that they're very biased by the few recessions that happened. I don't know whether they wouldn't have used the data from the Great Financial Crisis, but they would have used the data from the 1990 recession. Now, reminder, this cycle, interest rates have risen from pretty much 0.25% to 5.25%. So that's a big rise. So this chart shows what the authors expect the path of US inflation to be based on the big rise in US interest rates over the past couple of years. And the paper was published where the dashed line is, which must be Q1 this year. And they're expecting that inflation will rise over the course of most of 2024 and then start to fall in the second half of 2025. So the message from this paper is that monetary policy works with long and variable lags, and it particularly takes a long time to work in service-based economies like the US and the UK. The question really is to what extent has this paper been biased by the idiosyncratic inflation and economic data of the period on which they'd based the study? And can the results they've obtained be extrapolated to any period outside it? And that is open to question.
Mm.
Any thoughts, Richard?
Well, it's interesting, isn't it, Keith? It still suggests that this got this huge time lag between taking action on interest rates and its effect. And if it's correct, then the reasons that inflation has fallen significantly over the last couple of years is nothing to do with interest rates.
Well, that's true. We know that's true, actually. It's been a secular fall in energy.
So obviously then the next question is what's going to happen to the economy in about 18 months' time?
Well, exactly. That's right.
And are they all going to start falling off a cliff?
Yeah.
So we'll take a look at the effect of Trump's proposed tariff rises. Trump's fiscal agenda, according to John Authors, is very good for billionaires, bad for everybody else. So the Tax Cuts and Jobs Act, excuse me, was that Trump's original act?
Yes. Yeah, that's exactly right. Yeah.
Yeah. So his original act, when he was in his first term, adversely affect the lowest quintile to the tune of minus 3.7%, second quintile minus 2.4, etc., all the way up to the top 1%, who were benefited to the tune of 1.36%. So everybody except the top quintile was damaged by this.
Yes. So now he's planning to do more of the same.
Yeah. So what happened as a consequence of the Trump tariffs in 2018? So the majority of the tariff costs were passed on. 20% tariff rise resulted in a rise of about 19% in the ex-tariff price. So importers only absorbed a very small proportion of the tariff rise. There was an exception, which was steel, where importers absorbed much of the tariff rise so that they could remain competitive. But what this is really saying is that the rises are in fact effectively inflationary of their own account, unless of course there are countervailing tax cuts elsewhere which offset the tariffs, such that the tax rate remains neutral. So whilst import prices rose, those extra costs weren't always passed on to consumers. So washing machine prices rose, but other imported goods prices barely changed, and it's not clear where that tariff was absorbed in the supply chain, but it didn't end up particularly with the consumer.
Yeah. So this has been actually a bit of a debate in between economists. So if you look at just washing machine prices, they went up in line with tariffs, but a lot of other goods didn't. So you can cherry pick the data to come up with the answer you like.
Yeah.
So the lessons were that when retaliation came on US goods, retaliation was mainly on agricultural goods and commodities. And so US producers then had to reduce their prices in response. What we've just talked about with the prices being passed on by importers, but they're not necessarily being passed on to consumers, means that the US corporate sector absorbed a lot of the tariff rise through a combination of lower profits, higher prices, and lower wages. So it was paid for, but not necessarily in an inflationary way.
Mm.
So everyone's assuming, so I was assuming that tariffs would lead to higher inflation. Actually, the lesson is the inflationary effect may be much less than you might think.
So taking a look at UK incomes. So since 1999, the national minimum wage is up 320%, but UK inflation is only increased prices by about 80%. So
If
in
you believe
theory,
the
it should be making
statistics.
a whole cohort of people better off.
Yeah.
And you can see the age distribution there. These are charts of median disposable income by decile 2022-2053. And they show no meaningful rise for the second decile relative to the rest.
Yeah,
So,
I was really shocked by this actually.
yeah.
So I think what's going on is that must mean that food and energy inflation has really absorbed all the
And
extra disposable income.
where does rent fit into the rent? Presumably has
Yes.
also taken a big chunk out of it, hasn't
Yeah,
it?
no, you're absolutely right, Richard. It must be rent as
So
well.
in actual fact, what's happened is that the inflation that these low income people experience is very different to the inflation that's calculated and
Yeah.
publicized as CPI, and their inflation rate is much higher than 80%.
Yeah. No, I think you're right. I think it's rent.
So this is an example of wage compression that we've just alluded to. So if a charity is hunting for an eager graduate and a bright person to work full time with a £25,000 annual salary, which is a sort of typical starting salary for that type of graduate role, that salary next year will also be very close to the minimum wage, which at £12.21 an hour at the next April equates to £25,000 full-time salary.
Yeah.
So the graduate and his student or her student loan has got their degree so that they can earn the minimum wage that they would earn anyway.
Yes. That's right.
So to explore this a little bit more, in 1997, the median wage earner took home double that of the bottom decile. By 2023, it was only half, 50% more than the bottom decile. And between 2011 and 2023, real earnings of bar staff rose by 26%, while those of the median worker rose just 1.6% real earnings. So many jobs
Yeah.
require a degree offer salaries are now at or below the minimum wage. So a graphic designer with a degree and 2 years experience can expect to earn £22,000, which is £3,000 a year less than the new minimum wage from 1st of April, 6th of April, whenever it is next year.
So presumably they'll get the minimum wage.
They'll get the minimum wage. And then you end up with more and more people, youth, young people mostly, on the minimum wage.
Yeah. But
What's gone
graduates,
wrong? What's gone wrong with the economy, Keith?
well, exactly.
Something seriously awry with the economy. And yet you have law graduates joining magic circle firms at salaries of 150,000 a year with no
Yeah.
experience.
Yeah, but that's yeah. I don't envy them. You know how hard those kids work.
Yeah, but it's the value of those people to society 7 times greater than other graduates.
Well, the value of lawyers, discuss. To quote Shakespeare,
Do I
Henry
have to?
VI, Part 1, first thing we do, let's kill all the lawyers. So,
This is not. Can I just say this is not an inciting violence to anybody. It's simply a quote from a historical play.
well, exactly. But back in the 17th century, everyone hated lawyers. Things don't change in British society.
So that was just that chart was just showing that the minimum wage is now the level at which a student will start paying back their loan,
Yeah.
their student loan. A graduate start paying back their student loan, and this is the effective tax rates that people will pay. So if you're earning between 12 and 50,000 pounds a year, which actually is not a great deal of money in this day and age, 43% of that goes on tax. No, we just need to correct this. 43% goes on various income taxes. Okay, this is total, including employers' national insurance. And then any disposable income you have at the end of it, you pay 20% VAT on.
Yeah, that's true. Yeah.
And you're paying 20% VAT on the 60%, let's just say 60% that's left, which is actually £12, let's say, or £100, which is another 12% on your gross. So you can add 12% to your total tax rate to come up, assuming everything you buy has VAT on it. You don't save anything. So if your average tax rate is 40% as an individual, actually, when you add on VAT, it's 50%.
Yeah.
It's a disgrace. It's a complete disgrace. And they're going to wonder why nobody wants to go to work and nobody cares. And, I mean, they are so stupid. Sorry. You can edit that bit out, Keith.
Yeah.
It's ridiculous.
A party political broadcast on behalf of old people.
So Katie and I are on the train on Saturday evening, and there's a couple of young women we were sitting next to, and they were discussing, their friends, they were discussing buying their first houses. And they were saying how disgraceful it was that they had to pay this in, I don't know if they're their first houses, but they had to pay this enormous amount of stamp duty.
Yeah. No, I loathe stamp duty. It's a totally inefficient tax.
And it's incredibly iniquitous.
Yeah, exactly. It's another tax on young people.
It taxes young people, and it's a huge tax, and they have to pay it out of debt.
Well, out of post-tax salary.
Yeah.
So, when you talk about these numbers, you then have an enormous tax take when you try and buy a house.
It's a disgrace. It's a moral disgrace. Was it George Osborne who introduced it?
He was. Yeah.
That was a rhetorical question as well, Keith.
Yeah, no. What an idiot.
What an idiot.
So The Economist had this article about wage compression, and they had this quote from a lorry driver. What's the point in you working extremely hard if you can earn almost the same doing a minimum wage job? That's the point of this whole section, basically. So the effect of wage compression is a reduced incentive to develop skills or take additional responsibility. What's the point in taking, a managerial role in the bar when you're going to get a very tiny uplift in your salary compared to just waiting tables? I think there's a huge disincentive now to go to university, particularly for non-vocational jobs, because you then need to repay your loans the moment you get a job at an extra 9%. So all those university degrees that we've previously talked about, media studies, where you come out and you're a barista, well, you're a barista earning 9% and you're less than your colleague next to you. Either a lot of these graduates on rubbish degrees come out and then just don't bother working, and they'll probably just not go to university in the first place. The other problem is the teacher Peter Turchin theory of elite overproduction. So you produce a lot of graduates who then don't have good jobs. We've talked about this previously, and who are then unhappy, overqualified, not achieving the wage premium they think they have worked hard to deserve, and they are unhappy. And all the big revolutions in history have been caused by unhappy students.
And they have this massive debt overhanging them.
Yeah, exactly. And they've raised the price of tuition, so that debt's going to be bigger in future. Let's see what happens. Actually, and this is an aside. So everyone talks about reducing inequality, but inequality is actually essential in a capitalist economy, because you rely on earnings differentials to incentivize people to work and to learn and to invent and to increase productivity. The alternative is having set incomes for everyone, i.e. no income inequality, as you do in a communist society, and then what you have is political inequality. And then if you have equal incomes, so there's no incentive to work economically, you rely on political inequality to get people to work, i.e., if you don't go down the mine, I'm going to shoot you, or I'm going to send your family to the gulag. That's the alternative. And the effectiveness of the two systems can be seen in this chart. The line at the top is the GDP per capita of South Korea, a capitalist society. The one at the bottom is North Korea. It has a GDP per capita which is 4% that of the South. And students everywhere love communism. Why? So, and continuing this aside, in a capitalist society, there is theoretical political equality, but wealth and income inequality. In a communist system, there's the opposite. But in both, one leaks into the other. So in a capitalist economy, well, the rich can buy political influence. You see that very well in the US, where Elon Musk has become, a key part of the re-election campaign. And in a communist society, political inequality leads to extreme wealth for the elites. Just think of North Korea or Venezuela, and extreme poverty for everyone else. Rant over. Okay, so Richard.
So, will the recent rise in national insurance from Rachel Reeves be inflationary? So, if you go back to looking at the 2010s, there's no obvious rise in inflation or damp in private sector growth when there was an increase in employer pension contributions. So Rachel Reeves has raised national insurance by 1.2%, employers' national insurance by 1.2%, and reduced the threshold, paying it from 9,100 to 5,000. So a significant extra cost to employers. And what will they do with it? Well, my view is they will inevitably pass it through to consumers. So there have been a number of academic studies on the impact of one-off increases in employment taxes. And the OBR has estimated that the impact of the current rise in national insurance is going to give a 0.2% price rise spread over a number of years, which obviously is pretty minimal. And in the first year, 40% of the impact will be borne by businesses in the form of lower profits, with 60% borne by consumers in the form of lower wages and higher prices. I mean, not much is actually going to be borne by, well, it's going to be virtually impossible to tell how much is borne by lower wages, isn't it? Because there'll actually have to be lower wage increases.
Yeah, that's right.
Lower wages. So trying to tease that out is probably virtually impossible, I would suggest. And then longer term, they say there'll be a 24% hit to profits and 76% is going to go to consumers. But only 20% of the effect on real wages is expected to come through higher price rises, higher prices. I mean, I think this, my view on this as a non-economist is this is analytical gobbledygook.
Okay.
And I think it's virtually impossible to know what the effect will be in terms of how businesses will cope with this price increase, the cost increase. And ultimately, in a sense, society has to pay for it. And
yeah,
for me, the damaging effect is that there is a massive increase in the cost of employing people, particularly at the lower end minimum wage, which we're now saying is 25,000 a year. There's a massive increase in the cost of employing people at that end of the employment market, and it is clearly going to impact the way employers recruit people. And that, I don't think, I think, whether it's inflationary or not is probably a bit of an aside. The money gets taken away from the taxpayer and gets spent by the government. But I think it's going to have a seriously prejudicial effect on the operation of certain sectors of the economy.
Well, I think you raise a very good point, Richard, because actually the question in my mind, because I think that this study is good. I mean, there's lots of academic data on this, but the question is how much of the impact on real wages is through aggregate job losses
Yeah,
and rather than changes in real wages.
yes,
So, the consumer takes a hit and wages on aggregate are wage growth is lower in aggregate, but how much of that actually is people losing their jobs and not being hired, etc.?
yeah,
The data we've seen from Indeed suggests job openings continue to fall, and the anecdotal evidence from businesses is they're going to stop hiring and look to reduce staff. So, not good.
yeah. I completely agree. And the other, yeah, I mean one of the big impacts, of course, is the increase in the minimum wage, but it's also the national insurance threshold dropping down is very highly punitive on employers who employ people at the bottom end of the wage scale. So the OBR thinks the rise in national insurance will lead to one-off inflation increase of 0.2% over the next 2 years. So
Yeah.
effectively, no effect to
Yeah,
all
not
intents and
much.
purposes.
Yeah. So I have prepared a segment on the current condition of UK young people, and there's just not enough time. We'll do that next time, but I think that is important. On to Inflation Watch. Richard.
Thanks, Keith. So with next meetings of the various big central banks that matter to us, FOMC is the 17th, 18th of December, Bank of England 19th of December, ECB is the 12th of December. So we're very well mid-meeting at the moment. So UK CPI is UK 3.3%, US 2.6%, both up in October. EU
Yeah.
2% also up in October. Japan 2.3%, down in October. China 0.3%, down in October. And the core CPIs also sort of generally reflecting that. UK core is actually 3.3, US core is high at 3.3, EU core is high at 2.7, and
But
Japanese core 2.2.
but the point of looking at these in aggregate is, the trend, everywhere is up in October,
Yeah,
and core up or flat, not coming down in the West anyway.
yeah, yeah, agreed. I mean, something is inflationary pressures are rising again at the moment, aren't they?
Mm.
So this is a quick one. So we've got bounces due to energy prices primarily. Wage inflation is proving to be sticky everywhere. And we've said before that inflation doesn't just go up and down historically, it has
Yeah.
waves, and we may be on another wave up as part of the general downward path, but there may be a bounce in inflation that is appearing and that will dissipate over the next 18 months. I don't know, but I'm
Yeah.
conscious of this. Historically, this is what happens.
And onto recession watch. So, US bankruptcies are actually on track to be their highest since the GFC. Higher interest rates do have an effect on highly indebted companies. US small business, this is very interesting actually. The top left, US businesses sales, that continues to deteriorate. So small businesses continuing to be more pessimistic about sales, and the proportion of small businesses saying poor sales are their biggest problem is rising rapidly. And that seems contradictory to the strong retail sales numbers. Interesting. US consumers are digging into their savings to fund consumption. That is the net savings rate. The blue line, credit card delinquency rates. That is not a good number and appears to still be rising. Mortgage insolvency rates also rising. Poor people in the US not doing great. Serious delinquency rates for credit cards actually do appear to have peaked a bit, but at quite high levels. Again, young people suffering the most. And this is temporary employment in the US. I thought this was been to be a leading indicator,
Yeah, I remember that.
you know, and it's been falling very sharply. US economy doing just fine, employment doing just fine. So, in summary, US poorer households continue to struggle. There appears to be little danger of a US recession, but the jobs market is soft. On to other charts, Richard.
Okay, so there are now more 55-year-old and over workers in the US than there are 25 to 34-year-old workers, 55 and over being the white line. So this is the aging workforce at work, isn't it, Keith?
Yeah, I was absolutely amazed by this.
Yeah.
That really suggests that, as the boomers or whatever start to retire, you're going to get an inflationary problem in the US.
Yeah. What's the relevance of the public federal debt line in this chart?
Well, it's that, as the those workers, the white line starts to retire and they, start drawing on Medicare and Medicaid, this red line is going to get even worse.
Yeah.
And on to good news. Well, so this complicated graphic shows that scientists in Germany have found a way of extending the life of zinc ion batteries 100-fold. Okay, so zinc is much more abundant in the Earth's crust than lithium and also is much less reactive. So zinc ion batteries don't spontaneously explode, as you've seen on the various videos on YouTube and TikTok of somebody's scooter or electric bike just bursting into flames. That won't happen with a zinc ion battery. But they're not used much because they have quite a low lifespan. But if these German scientists' innovation is correct, then zinc ion batteries could start to threaten lithium ion batteries in the market. So whenever we've talked about batteries, we've talked about dendrite formation. So top right here, what happens is in a battery, the metal ions have to move between the anode and the cathode. And as they do so, those ions can tend to form dendrite pathways between the anode and the cathode, effectively short-circuiting the battery. And this is a problem for all batteries and is one of the main reasons why your lithium-ion battery steadily declines in performance over time. So what they've done is they've developed a polymer to coat the anode that allows zinc ions to move smoothly through it without forming dendrites. If that is commercialized, that is great news. The zinc ion batteries would be cheap and abundant, basically, and would not explode.
I think one of the reasons for not buying an electric car till you have to is that battery technology is continually advancing.
Yeah, I agree. And the other thing is that all these batteries, like lithium-ion batteries, the recycling, nobody, whenever it talks about the environmental benefits, nobody talks about the recycling problem. These, big, nasty, toxic things.
Yeah, exactly. I wonder what the carbon footprint of recycling one of those batteries is actually.
We don't talk about that, Richard.
We should ask Ed Miliband. He'll know.
He'd say it's negative, Richard, and it's good for the planet. And onto equities. So generally an indifferent couple of weeks for equities. Bitcoin, the standout. Bitcoin up another 20%, up 126% on the year. Amazing. FTSE 100, FTSE All Share actually doing all right, up 2% over the last couple of weeks. So this is the all world. It's pretty much flat since over the last 3 months. The FTSE had a big bounce in the last couple of weeks. So recovering from its budget malaise. Euro stocks having a bounce despite a weakening Eurozone economy. S&P 500 very close to its all-time highs. Nasdaq the same, up 26.6% on the year. Russell 2000 doing well, up almost 20% on the year, and experiencing some Trump optimism. US market outperforming absolutely everything else. Hang Seng down 7.2% over the last couple of weeks. The optimism over the stimulus package fading again. Topics going nowhere. Bitcoin off to the races. Is it going to cross 100,000? Question mark. Sterling falling 1.25, down 3% over the last couple of weeks, down 1.6% year to date. Euro heading towards parity. The Eurozone not doing well. ECB expected to cut rates. Dollar index off to the races. So Trump tariffs, so the prospect of Trump tariffs, higher inflation, US interest rates staying higher for longer as the economy remains strong, all that very good for the dollar. That, of course, is very bad for any debtors who have debts in US dollars, particularly emerging markets. Rapid rises in the US dollar are associated with credit crises in the emerging world. Watch this space. VIX going nowhere. Charts related to equities. So this is the BlackRock Bitcoin ETF, and it is the most successful ETF launch ever. It has rocketed to 40 billion in assets, whereas most other ETFs take a long time to get to that level. So punters like Bitcoin, and there's a very strong correlation between Bitcoin and the Nasdaq, actually. It's like speculative assets. The everything bubble continues, and Callum Thomas's euphoriometer is at all-time highs. That looks at VIX, bullish sentiments, forward PE ratios, valuations, etc. Everyone is bullish. Risk appetite's very high. Everyone expecting the market just keep on climbing higher. But, said this many times, we've been totally wrong. Stocks look expensive. Compared to bonds, the equity risk premium is now negative. So you get higher yield buying bonds than you do equities. Stocks are expensive. And you look at their company profit margins, very high. How much higher can they go? Valuation, forward PE ratio, very high and just keeping on climbing. Fundamentals don't look great. This is forward EPS estimates for 2025, and over the last quarter they're down, but S&P's carried on climbing, which means that PE ratio on the S&P 500 is rising. One thing supporting equities in the US is buybacks and low equity issuance. So if you look at equity supply, it's negative. I thought this was interesting. According to JP Morgan, the average US retail investor is just 3.7% this year, far lower than the 25% of the S&P 500. So retail have not been buying big tech, and more on how expensive US equities are. The red line is free cash flow per share in the US and the S&P 500. So although earnings per share has been rising, how much of that is dodgy accounting? And also they've been spending a lot of that earnings on investment. So Microsoft, etc., upping their capital expenditure has led to free cash flow going nowhere, not available to be paid out to shareholders. So the only equity valuation chart you need, which we've talked about many times, this is the overall equity allocation. This is the overall asset allocation to equities and has a strong inverse correlation with future equity returns over the next 10 years. That is showing the equity allocation is really high, which is associated with very poor equity performance over the coming decade. We've been saying this for a while now, as equities continue to do really well. And on to commodities. Energy, actually generally strong. Industrial metals, generally weak. Precious metals, gold bounced back. So this is energy. So over the past couple of weeks, Brent and WTI are bounced a bit, but are still down on the year. Natural gas in Europe continues to rise. That's bad news for inflation and bad news for European consumers on supply concerns over gas coming from Russia. US natural gas futures also rose strongly and are now up 25% year to date. Coal still drifting off, uranium going nowhere. This is oil. Tensions in the Middle East have led to a bit of a bounce for oil, but it's still low, down 2.5% on the year. WTI down 0.7% on the year. Numbers specific to the oil market. Well, over the past couple of weeks, inventories have continued to draw down in the US. So oil price is weak, but the US market is still undersupplied. Oil production in the US ticked down last week, presumably due to winter maintenance or something, to 13.2 million barrels. That one is correct. So, there's something wrong with their estimates, I think. And the Baker Hughes rig count is unchanged. Now, the IEA is forecasting the oil market will be in surplus by over 1 million barrels a day in 2025, and that's even if OPEC Plus doesn't increase production. The oil price looks to be structurally weak. Kazakhstan continues to cheat and has exceeded its OPEC Plus quota every month this year, and that is one of the reasons that Saudi Arabia is fed up and is planning to open the taps in 2025. This is the forecast production of OPEC if it were to follow through with its plans to increase production by over 2 million barrels a day next year. That will kill the oil price. Let's see what happens. European natural gas, this is not great. Very strong rises over the past couple of weeks. So I'm going to read this out. Russian gas exports to Europe via Ukraine was stable through the past week, despite ongoing contract disagreements between Gazprom and the Austrian company OMV, which caused flows to temporarily be halted last Saturday. Still, the outlook for supply to Europe remains uncertain in the coming weeks, as data from Eurostream indicate that low requests through Austria and Slovakia remained below levels than before the supply halt, and that lifts prices. Flows through Ukraine are due to end by the end of December due to attrition during the Russian-Ukraine war. So we still get 5% of our gas from Russia. That is leading to the threat of disruptions to that is leading to higher prices. UK, the same, up 9% over the past couple of weeks. US natural gas futures also done well as it gets cold, up 26% year to date. Coal going nowhere. Uranium, actually really no sign of the bull market continuing. Onto industrial metals. Well, generally weak actually. Big standouts were copper. Dr. Copper down 5% over the past couple of weeks. Dr. Copper diagnosing a weakening manufacturing economy. Lithium, though, had a bit of a bounce, still down 18% on the year. Tin fell 8.6% over the past couple of weeks, but is still up 12.8% year to date. This is aluminium, up 0.2%, going nowhere. Cobalt, flat as a pancake. Copper, that has been weakening, showing no signs of life and diagnosing an indifferent, weakening global manufacturing economy. Chromium, weak. Iron ore, going nowhere, so no sign of a pickup in Chinese construction activity as evidenced by the iron ore market. Lithium had a bounce from its lows, still down a lot from its highs. Neodymium, well, the recent bounce fading. Nickel going nowhere. Reminder, got a wall of nickel coming out of Indonesia in the coming years. Tin topping out, actually. Zinc topping out. Onto precious metals. Gold had a bit of a bounce, up 1.2% to $2,716 an ounce. Silver flat. The PGMs, weak. This is gold, bounced back from recent weakness. Silver, not followed gold, well off its recent highs. Platinum, going nowhere. Rhodium, weakening again. Palladium, going nowhere. On to rates. UK yield curve is terrible. The market expecting rates to bottom at about 4%, 4.25%, and very strong positive yield curve. Basically, nobody wants to hold UK gilts long term, charging a big premium to be lending to the UK for 30 years compared to other countries. Terrible for me. I've had a terrible year, got killed. This is much more normal. You see the premium in the US between the 30-year and the 5-year is what? 20 basis points. In the UK, it's more like 50. The term premium in the US has risen very sharply in the past few months. And that has to be uncertainty over inflation and what Trump's going to do. And bond yields throughout the world set by the US. So that has led to rising bond yields everywhere. This is the Bank of England's balance sheet as a percentage of GDP. QT has come in, but there's still quite a long way to go, I think, to get the balance sheet back to anywhere near normal levels. Fed, similar. Now, the market is expecting a soft landing in the US and for interest rates to bottom at around 3.75%. So 4 more rate cuts in the US is what the market's expecting, and that to be the bottom. No recession. Market expecting a soft landing. Looking at some charts, this is the UK 2-year. So 4.33 current UK interest rates, 4.75. Market not expecting UK rates to be cut much in the next couple of years. The 10-year still towards its highs for the year, 4.4. 30-year very much at its highs for the year, 4.85. Terrible for me. I've been murdered. US 10-year, 4.33%. So not at its highs for the year. UK market has been very much undermined by the budget, which was perceived by the market as inflationary. In the US, where the budget deficit is much higher, and unlike the UK, they have no plans to get the budget under control, whereas in the UK, at least we do, the market is charging substantially less to lend the US money compared to the UK. The Labour government has knocked market confidence. German 10-year collapsing. It looks like the Eurozone is going back into recession and inflation then will come right down. This is French. Reminder, France is running an absolutely enormous budget deficit and it's got an unstable government, and yet the market is charging a lot less to lend to it than to the UK. UK 10 years at 4.5%, French 3%. So you get 50% more yield buying UK compared to France. Or put another way, the market requires a 50% yield uplift to lend to the UK. Concluding comments. The everything bubble continues, Bitcoin going through to the moon, Peanut, the new cryptocurrency, shooting to the moon, equities generally doing well. UK and European economies appear to be slowing, though. The US remains strong, but all this is highly contingent. Let's see what Donald Trump does. If he cuts the size of the US economy, that will be bad for the US economy. If he raises tariffs, that will be bad for inflation, though, as we've discussed this week, not necessarily as bad as you might think. It will, however, really hit its trading partners and possibly lower paid workers in the US. Deporting illegal immigrants will tend to be inflationary and tend to raise wages. A lot is going to happen during the Trump's second term. We'll be here to document it. Stay tuned. Richard, what have you been up to the last couple of weeks?
So I haven't really been up to very much, Keith. I'm afraid I'm terribly boring. I've just been so gold has and silver, precious metals have taken a bit of a hit, as we know, and I think it's just part of the general volatility in the long-term uptrend. So I am and still sitting on my hands. Uranium has had a little bit of a resurgence, or at least the stocks have. And I guess one thing I have done is I have shifted some of my uranium investment into the enrichment processing part, because the big bottleneck in one of the big bottlenecks in the provision of fuel rods to nuclear power plants is enriched uranium, and most of the uranium is actually enriched in Russia, I think 75%, which clearly doesn't tally with the US wanting to make it, and actually the West wanting to make themselves independent of Russian uranium supplies and enriched uranium. So a little bit of a change there. How about you, Keith?
My portfolio, absolutely terrible. I've lost a lot of money this year. I have expected falling inflation to lead to lower interest rates, lower bond yields, and the opposite has happened. Bond yields have risen sharply. I've lost a lot of money, and this is the 5 stages of grief, and I've kind of got to acceptance. I've lost a lot of money, and medium term, I think I'm waiting for inflation to finally come down in the UK and us to go into recession, the US and the Bank of England then to cut rates hard, at which point I think I get out of this trade with some skin intact. Right now, I lost a lot of money, not much fun, and it's just a question of holding on. I don't think that as we've discussed many times, I think equities in the US are just ridiculously overvalued. They can keep on climbing, but valuations are increasingly stretched. At some stage, they will come back down. They always do. Now, this week, I crave your indulgence. Viewers on the Discord will know I've been having a difficult couple of weeks dealing with my aged father who is in hospital. And it has reminded me that the most important investment you can make in life is in your relationships. So I'm going to crave your indulgence here as I quote some Auden. Now you'll be thinking, and to quote Miss Piggy, pretentious moi, but I went down to the hospital to read to him because he was in, euphemism, a confused state. And although he doesn't necessarily understand what you're saying, you have to fill the time and you hope he will enjoy the sound of your voice. And I read him some poems and I thought the Auden was very good. And so here goes. In headaches and in worry, vaguely life leaks away, and time will have his fancy tomorrow or today. Into many a green valley drifts the appalling snow. Time breaks the threaded dances and the diver's brilliant bow. The glacier knocks in the cupboard, and the desert sighs in the bed, and the crack in the teacup opens a lane to the land of the dead. Oh, look, look in the mirror. Oh, look in your distress. Life remains a blessing, although you cannot bless. Oh, stand, stand at the window as the tears scold and start. You shall love your crooked neighbour with all your crooked heart. It was late, late in the evening. The lovers, they were gone. The clocks had ceased their chiming, and the river deep ran on. So, investment advice of the week is love your crooked neighbour with all your crooked heart. And on that note, it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.